Want to learn a smart way to steadily grow your money? Imagine making an extra $4,400 every month just by being smart with your investments. That's the kind of opportunity Warren Buffett talks about when it comes to dividends. While it might sound too good to be true, dividends can actually be a powerful tool for growing your wealth over time. In this insight, we'll uncover Buffett's strategy and show you how you too can potentially earn significant dividends each month. But before we jump into the details, don't forget to hit that subscribe button and stay tuned until the end for the key tips that could help you boost your investment returns. Let's get started. The Warren Buffett way with dividends. You know Warren Buffett, right? The big shot investor? Well, he once said it's awesome to make money even when you're catching sleep. Dividends are like that magic trick. They let you make cash while you're snoozing. Okay, so when you buy a piece of a company's stock, it's not just a piece. It's like you're becoming a part of that company. Now, when that company rakes in the dough, fingers crossed it does, they've got choices about what to do with that cash. One option, they can share some of those profits with you, the shareholder. That's what we call dividends. But wait, here's the cool part. They're not a one-time deal. Nope, they often roll in regularly, like every 3 months. Some companies might dish them out monthly or yearly too. Usually it's cash, but sometimes they're like more pieces of stock or a plan where you get more shares instead of cold, hard cash. Think of dividends as your slice of the pie when the company decides to dish out its profits to you, the shareholder. And here's the kicker. They're not just a one-time bonus. They can be a steady income stream for investors. That's why they're key in building wealth and hitting financial freedom. Even Buffett, the legend himself, has used this move to stack up his riches over the years. Building a strong portfolio. Buffett really hammers home how crucial it is to have a solid mix of investments. He says spreading your money around is like a safety net for not knowing everything. It's not all that useful if you're pretty clued in already. But, okay, how exactly do we put together a super strong portfolio that pays dividends? Well, making one that lasts means having a smart plan. Let's dig into the important parts that'll help you make a killer dividend, producing setup, just like Buffett suggests. Picking dividend, paying stocks. First things first, choosing the right stocks that pay dividends is key. Look for companies that regularly pay dividends, especially those that have a history of either maintaining or increasing their dividend payments. These companies are often found in sectors like everyday essentials, utilities, and healthcare. It's essential to do your homework here. Understand how financially healthy a company is, what sets it apart from others, and its ability to generate consistent cash flow to keep up with those dividend payments. Spreading out your investments. Think of diversification as not putting all your eggs in one basket. It's like having different flavors in your ice cream cone to reduce the risk. Spread your investments across various industries and sectors. This way, if one area takes a hit, your whole portfolio won't go down with it. Remember, while dividends offer income, the value of your investments can go both up and down. Diversification acts like a safety net. Thinking. Long-term. Buffett believes in playing the long game. Imagine you only have 20 chances to make investment decisions in your life. You take your time, make thought out moves, and probably wouldn't use all 20. That's the kind of patience and strategy you need. For dividend stocks, especially, think long-term. They have this cool ability to multiply over time, especially if you reinvest those dividends back into your portfolio. It's like a snowball effect, boosting your income down the road. Evaluating risk. Avoid companies that have huge debts or often cut dividends. These are warning signs that can rock the stability of your portfolio. Focus on companies with a solid financial foundation, ones that have proven they can weather economic storms. And lastly, don't just sit and forget. Keep an eye on your portfolio regularly. Companies change, economies shift, so you might need to tweak things now and then to keep your portfolio in line with your financial goals. By sticking to these steps, you'll build a powerful dividend portfolio that can bring in a steady flow of income, helping you reach your financial targets. So how do you live off dividends? Well, let's get into the nitty-gritty, making your money work for you, just like Buffett has stressed over the years. Blue chip dividend stocks. First up, invest in blue-chip dividend stocks. These stocks are like the rock stars of the investment world. They're big players established in their industries, known for their stability, and they consistently pay out dividends. What's so attractive about them? They tend to stay strong even when the economic seas get choppy. That's why they're a safe bet for folks looking for a reliable source of dividend income. Buffett talks about the importance of temperament in investing. Basically, he says it's not about being super smart, but about having the right attitude. He advises having the patience to stick with your investments for the long run. That's crucial when it comes to blue-chip stocks. Instead of chasing quick gains, focus on these companies with a history of strength. They've got solid market positions and competitive advantages, and they've been rewarding their shareholders for years with those juicy dividend payouts. Adding these blue-chip dividend stocks to your portfolio sets you up for a steady income stream. They're not just about stability and income, they can also grow your capital over the long haul. It's all about quality investments and thinking for the future, something Buffett has preached about. This strategy, tried and tested, could be your ticket to living off dividends and hitting your financial targets. Dividend growth stocks. Another cool way to make that money work for you is by diving into dividend growth stocks. These are different from those rock-solid blue-chip stocks we chatted about earlier. They're the ones that not only dish out dividends but keep cranking them up as time goes by. Remember what Buffett says about investing in yourself? Well, it's kind of like that, finding companies that keep growing and keep boosting those dividend payouts. So, where do you find these gems? Think industries with loads of room to grow or companies coming up with crazy innovative stuff. They're the ones putting their earnings back into getting bigger and better, while also giving their investors a nice boost in dividends. Here's the cool part. These stocks are like compound interest on steroids. As these companies up their dividend game year after year, your income doesn't just grow in dollars, it grows bigger compared to what you first put in. That snowball effect? It speeds up your journey to financial freedom big time. Sure, these stocks might not give you the biggest cash flow at the start, but their potential to rake in serious dough in the long run is off the charts. They're for the folks who get the whole compounding deal and are down to let time do its thing. As your investments grow, so does your paycheck. It's like setting up your cash flow for a life fueled by dividends. Putting your money in these dividend growth stocks isn't just about buying stocks, it's about investing in your future. It's totally in line with Buffett's idea of playing the long game and always learning. Consider tossing some of these promising dividend growth stocks into your mix and watch your path to living off dividends light up. Covered call ETFs. The third stop on our journey toward financial independence via dividends brings us to an intriguing twist. Covered call exchange, traded funds, or ETFs. Think of these investment tools as a nifty addition to your dividend game plan, following the wisdom of none other than Buffett himself. Now let's break it down in simpler terms. Covered call ETFs are kind of like a mixtape of stocks and options. They hold on to a bunch of stocks that pay out dividends, and at the same time sell options on those very stocks. This little move generates extra cash for investors, potentially beefing up those regular dividend payments you receive. Here's the gist. These ETFs round up top, quality dividend, paying stocks, and then sell call options on them. Now, a call option is like a golden ticket for the buyer. It grants them the right to buy the stock at a set price within a specific time. By selling these call options, the ETF pockets premiums, dishing them out as dividends to its investors. But here's the catch. While this strategy guarantees steady income, it also puts a lid on how much your stocks can grow. If the stock prices skyrocket, the ETF might have to sell them at the pre-decided price, missing out on the extra gains. Covered call ETFs are made for folks who prefer a reliable income over wild potential profits. They're a hit with those who want to beef up their dividends without gambling too much. These ETFs let you squeeze more out of what you've got without shaking up your investment style too much. Want examples? Check out the Global XS&P 500 Covered Call ETF or ProShares K, one free crude oil strategy ETF. Each has its unique way of playing the market while guaranteeing some sweet income. So consider adding these ETFs to your money mix. Buffett's advice on patience and balancing income with potential gains could just lead you to financial independence avenue. Let's break down the numbers to see how you could hit a goal of $4,400 a month using covered call ETFs compared to the traditional way of investing in dividends. If you aim to generate $4,400 every month from covered call ETFs with a 12% annual yield, here's the math. First, figure out the total annual income required. $4,400 per month times 12 months equals $52,800 per year. Now, divide this annual income by the yield percentage to find the total investment needed. 52,800 divided by 0.12 equals 440,000. That means you'd need to invest around 440,000 in covered call ETFs with a 12% yield to make 4,400 each month. Now let's compare this to the traditional dividend method, assuming a more common 3% yield for blue chip stocks. The total investment needed for the same annual income of $52,800 using a 3% yield would be $52,800 divided by 0.03 equals $1,760,000. So, you'd need to invest about $1,760,000 in traditional dividend, paying stocks to make that same $52,800 annually. What if you could unlock the secrets behind Buffett's dividend strategy and make $4,400 monthly? What would change in your life? Let us know in the comments.